Forced loan recalls could be coming as soon as this next upcoming week. And if you think for a second this will not have a positive effect on stocks such as AMC, aka your riskiest trades in this market, you would be wrong. At least that is what history would suggest to us. When did Volkswagen squeeze? Well, at the height of the banking crisis. Banks withdraw these loans faster than you can even blink. How does this happen and why does this happen? Well, let me give you a little bit of an inside scoop. Come a little bit closer. So there's illiquid and liquid assets and loans, right? Well, real estate, car loans, consumer loans, your credit card lines, stuff like that is very illiquid. Banks aren't usually just going to call up and cancel your credit card. I guess they might be able to. In theory, they might have the power to do that, but they don't do that. They don't come try to get your car back. They don't try to come sell your house on you because they can't do that. So where can they pull capital from? Because after all, you're not going to raise capital via issuing shares. Hell no, that's what caused SVB to collapse. You're not going to do that. No way in hell. But what you're going to do is withdraw those liquid loans in money markets, because these hedge funds, they're willing to pay out a sweet penny to get a loan and to go make a trade. So what do banks do? They go ahead and they look at their balance sheet and they say, where can we pull back? How can we get access to our money back? Because that's all that matters. Forget trying to make money. When banks are going under and banks such as JP Morgan, Citi, Bank of America are about to lose $5 billion apiece, roughly 2 to 5% of these companies' market caps, well, that's a problem. You're going to have to pull some liquidity out of somewhere. And hedge funds, when they take out these loans from banks, it's fully an option to recall that loan at any point. Banks have the power to do that because it's a very liquid market, and the terms of these loans are not very favorable for hedge funds in case something like this did happen and there was a liquidity crisis. Because after all, nobody's going to care more about someone else's finance than your own, right? JP Morgan is not going to care about Wells Fargo as much as they care about JP Morgan. Or they're not going to care as much about Citadel as they care about themselves. So you're going to start seeing forced loan recalls. And let me give you guys a brief rundown. JP Morgan, Citi, Bank of America, they all pledged $5 billion apiece to help bail. And I believe it was Wells Fargo as well, pledged $5 billion apiece to deposit it into First Republic Bank to try to save this bank. Morgan Stanley, Goldman Sachs pledged $2.5 billion apiece. Capital One, Truist, M&T Bank, they put up $1 billion apiece to deposit into First Republic. Uninsured deposits. Oof, that's a problem. Because First Republic is about to go into receivership over this weekend. At least that is the most likely outcome, as First Republic stock has fallen from about $14 to start off this trading week. And now it's sitting at about $3 and some change. And that's what the headline of this article says. Quote, First Republic most likely headed for FDIC receivership, sources say. Shares drop 40%. So these financial institutions are about to take major losses. These are clients' deposits. These are not $5 billion of JP Morgan profits they put in First Republic. Those are customer deposits that just went down the toilet, right? That JP Morgan and these other firms are not going to have access to at the very minimum for months as it does go through FDIC receivership. That's a big problem. So let's dive into the situation a little bit more and then talk about the effect and relationship this could have on AMC. So sources told CNBC's David Faber that the most likely outcome for the troubled bank is the Federal Deposit Insurance Corporation to take it into receivership. That stock slid about 40%, was halted for volatility multiple times. The FDIC is asking other banks for potential bids on First Republic if the regulators were to seize the bank. Sources told Faber. There is still hope for a solution that doesn't include receivership, according to those sources. First Republic told Faber on Friday that, quote, we are engaged in discussions with multiple parties about our strategic options while continuing to serve our clients. Fancy talk for, yeah, we're going under. And they lost from about $170 billion of assets under management to $70 billion of assets under management during the whole SVB collapse. So I imagine as the share price has been tanking, they've probably lost a lot more deposits, right? And that $70 billion, if you add the $30 billion from banks, it was about $100 billion. So the number was actually $70 billion, a lot worse than people expected. So now we talked about what kind of effect this has on banks, right? As banks take these big losses, and as people really start to freak out, let's call it for what it is, people are going to start to freak out again. Banks try to shore up their balance sheets, and they recall their riskiest loans. They recall financial loans that they can recall on. Because your credit cards, your cars, your houses, consumer kind of loans, you can't recall those kind of loans. But you can recall loans, or even businesses, you really can't even recall like those loans. Those loans are pretty hard to recall. I'm sure some terms and some loans banks might be able to, but they don't like to do that because after all, that affects the economy, that affects their business in the mid to long term. But they do pull loans from hedge funds quite often in series of distress. And that's because they're allowed to. Now, who gets their loans pulled first? Well, let's be honest. It's usually the small and mid-size hedge funds and money market funds because they have just less liquidity. If shit were to hit the fan, for lack of a better word, well, the big guys, they're probably going to be able to last a little bit longer than the small or mid-tier firms. Now, we know there's firms of all different sizes that are, one, shorting AMC stock, but are also in quite a bit of trouble, right? They're not all doing too good. Citadel, they returned like 18% so far in 2023. But other than that, you have not heard good returns coming from hedge funds. A lot of them are down massively. This is a pretty ugly market unless you're in the top 5 stocks in the S&P 500. It hasn't been pretty. Now, the first loans that do get recalled are the riskiest ones, are the loans that are out for, one, short positions. That's number one, because after all, a stock can only go to zero, but it can go very high, right? It could go to infinity, right? Well, specifically with AMC stock, why I think there's going to be a lot of forced loan recalls in regards to AMC specifically, it's because there's a lot of uncertainty around this arbitrage trade, and you're at the highest short interest numbers that we have seen in this whole meme stock trade, quote unquote. So I think it makes a lot of logical sense. If you're going to pull loans away from someone, somewhere, well, it should probably be these guys. And any risk management department at JP Morgan, Goldman Sachs, Morgan Stanley, they're going to look to the meme stocks first. Look at Top. The stock just rallied 1,000% in a day. You don't want to have a loan to a hedge fund if they're short on that stock, right? Same thing can happen to AMC. What are the odds that an Apple goes up 1,000%? It's not going to happen, right? Apple would be a larger market cap than the United States total debt. That would never happen, ever. Would never happen. So pulling loans away from firms that are heavily invested in stocks like Apple and these stable companies, think stable companies, is a lot less likely than some of your small, mid-cap, and meme stock kind of hedge funds. So that's a rundown of kind of what you guys should be thinking about over this weekend, especially as First Republic does go into FDIC receivership. It might not be pretty for hedge funds, and hedge funds have already lost so much money in AMC shorting the stock in 2023. It's an unprofitable trade at this point. It makes no sense to be in this trade, and I think this bullishness does continue and will continue for quite a while here. So Enough of that. I think you guys are pretty clear, hopefully after this video, how and why these forced loan recalls will happen and where they will happen. Banks shoring up their balance sheets. Brief rundown. You got liquid loans. The only real capital that they can pull out. They can't go to the markets and do a stock sale. Their stock's going to get absolutely whacked like an SVB. That's what caused their whole collapse. That snowball effect was because they wanted to realize some losses and to raise capital at the same time. So that's not an option. Well, the only place you can pull money from that's liquid is loans out to hedge funds or mutual funds, right? That's where you can get liquidity back. If you're a bank, say like JP Morgan, that is about to lose $5 billion and have that locked up at the very minimum for months, you're going to pull that out of your riskiest clients first. And the riskiest clients are the ones that are shorting said stocks like meme stocks. So I think that's important to pay attention to. If you guys did not catch that, go ahead and rewatch this part of the video again. Now, the live short interest of free float currently for AMC stock is sitting at 26%, 134.28 million shares that are currently sold short. Cost of our average of 354%, cost of our max 359%, cost of our minimum of 332%, cost of borrow rates from interactive brokers sitting at about 200% with 600,000 shares that are currently available to be lent out, and $706.5 million worth of short positions currently on AMC stock. Days to cover at 5, cost to borrow, again, 3-month average, 256% and 100% share utilization. I also do want to take a look at the average days out on loan to see what that is doing. And if we go ahead and pull that up, it is going higher yet again, now at 118 days. That's insane, dude. That means ever since this arbitrage trade became a thing and it was announced, hedge funds have not covered on their short positions at all. They've just been adding to them. 117 days out on loan. That's ridiculous. Go pull up any other stock and you're not going to see numbers like that. That is very uncommon to see these short positions on average being out for 118 days on average. Yeah, that's not good. At least for the hedge funds and the pain that they are about to feel. Now, take a look at the option activity for the day. So far, you have seen 42 orders totaling $26.5 million with AMC stock. Positive order value of 1%. But if we go ahead and take a good look at AMC stock is up 1.63% heading into the end of the day, well above the 50 and the 100-day moving averages at roughly $5.30 per share. AMC is at $5.46 per share, so pretty comfortable here. And I do think these factors that we just talked about, forced loan recalls and the imminent earnings that are going to be coming out for AMC coming next week, I think there's a lot of bullish things going for AMC. Not to mention court being delayed until the end of June. These cost to borrow fees, the way that they are, and the loss that hedge funds are incurring, they got to hedge out that short position at the very minimum. Hedging out a short position is bullish no matter which way you put it, no matter if they're buying stock in AMC or they're buying options in AMC. It is bullish buying pressure, and I do expect that to continue, and I do think $657 per share is in the cards relatively soon. Now, if the markets do crash and you do see a liquidity crisis and this collateral crunch that I expect to happen with AMC could go a lot higher a lot sooner. I mean, it's hard to tell. Shit could hit the fan by next week, and maybe it does. You have the Fed meeting coming on May 3rd. You have Apple earnings on May 5th. You got AMC earnings on May 5th as well. With this whole bullish backdrop with AMC, I can't make a bearish case for the stock right now. I just can't. It's hard to do that unless earnings were complete dog shit, which we're not expecting great things from AMC. Sure, that could cause a little bit of downside here. Or if we just got some random news that the judge approves the settlement, which I think is highly unlikely, that's the only other bearish case I can make for AMC. But I could sit here and make probably 5 good bullish cases for AMC, and we've done that here in these videos. So my opinion on it, there you have that. Now, Just like I said, again, you do have the Fed meeting next week. You do have more data coming next week, as well as Apple earnings and a lot of other earnings as well. I like to point out Apple because they're 10% of the NASDAQ. They're 7% of the S&P 500. So yeah, what happens with Apple is very important. For context here, if Apple dropped 10%, that means the NASDAQ would automatically go up 1% off of just Apple. That's insane. Now, if Apple rallied 10%, the NASDAQ would go up 1%. So it's very, very important. But again, keep in mind what happens over this weekend with First Republic Bank and how the rest of the world does react to this news. If you get more fallout, even in Europe, right? Think about Credit Suisse that just went under and UBS just bought them. I mean, to see more instability globally is not out of the cards right now, and something that I'll be paying very close attention to. So thank you guys for watching. Hit that like button, subscribe to the channel, source your comments, questions, or concerns down below in the comment section. You guys enjoy the rest of your day. And if you guys want to come trade with me live in real time, I should say that as well. This is the sponsor of this video, myself. Link down below in the description of this video. Get all my trades in real time. Made some trades today. Had a over 300% winning trade as well on First Solar. Check that stock out. It's been pretty rough today, as well as a couple other really good winners. We do have a trade on AMC as well that I'm very excited about. Like, I'm not just saying these bullish things just to say them. I'm actually putting my money where my mouth is, actually making trades on it. But I'm not a financial advisor. You could lose all of your money with any one of those trades or anything that I say in these videos. So come to your own conclusions. Again, thank you guys for watching. Enjoy your weekends, and I will see you in the next one.